All right, so let's talk about bubbles. Who know about this guy, Hyman Minsky? Anyone heard that name? Okay, then you're going to learn something. It's a fine professor, or late professor of economics, who basically created the framework of what we now consider to be the bubble cycle. He basically looked at all the different types of bubble and bursts throughout the history of the modern economy and saw consistent patterns in each instance. Now, whether you look at this as 5 steps or 7 steps, you'll get some difference of opinion on that. 6 and 1 ain't half doesn't I list all 7 here, but I'll show you which ones are sometimes taken out of the list. So if you do your research, you may or may not see a couple of these. But the first step is dislocation, disruption, innovation. Something new bumping off something old. Sometimes we call this creative destruction, or at least some aspect of this. In any case, there's a change, maybe even a fundamental change in something, some business. Like we had the dot-com bubble. There was a change in the way commerce could be executed. People could buy from home through their computer. Now, it's true that there were mail order catalogs in the past, and people could always do phone purchases. It wasn't as exciting, and it wasn't as interesting as buying things on the internet. So it was new, a dislocation. After that comes, boom. Everybody wants a piece of something new, something exciting, something that's displaced the old. They went in. In the case of stocks, it generally caused people to buy that stock or just get involved into that type of stock. Following the boom, people get ridiculous with the boom because as more money gets poured in, a sort of euphoria begins. Alan Greenspan was oft quoted for saying it was irrational exuberance. How many have heard that one? Yeah, we all heard that one. Okay. So that's part of the process. Note to the future. If you're investing long in a stock and people start talking about irrational exuberance, sell. Because you know you're halfway through the bubble cycle. Because after there's euphoria, then there's excess. This is the 4th step. I kind of consider it really to be part of the euphoria. So whether it's broken out is kind of a matter of opinion. That's why I have it kind of indented here. But when you get to excess, then you have things like you're riding a taxi cab, and the cab driver's giving you stock tips. That's kind of where there's excess in the system. At least that's a symptom of that sort of excess. It means everybody's getting in on it, even people that may not know what they're doing. Usually in a typical stock bubble, this is followed by profit taking. People that have seen this play out before kind of wise up to it and say, you know what, this looks like time for me to take my money off the table. Now, whenever people start taking their money off the table, what happens to the price? It goes down. Once it starts going down, people panic. And it starts going down faster and harder. To the point that there's even a revulsion, which is sometimes numbered as the 7th step of whatever it was, total rejection. In the dot-com bust, a lot of great companies got taken down with the toys.com and the, any stupid idea.coms that went down in the dot-com bubble. Which was actually a great buying opportunity. After a bust, look at which ones are actually good companies. After my housing business went down the toilet, I made a fortune on Ford Motors. Because I bought it at $1. What is it? I think it's like 17. I dumped $500,000. Worked out great. Yeah. But this is the cycle. Now let's see how this works with the housing bubble. Well, same basic steps. First, dislocation. Now, houses are not that different from what they've been for hundreds and hundreds of years. So it wasn't like there was some innovative way of building houses or some new thing. Really, the innovation that created the housing bubble was the derivatives markets that I showed you in an earlier slide. There was a new creative method for producing, pricing, and putting out onto the exchange asset-backed securities and their derivatives. We'll talk about that in a second, but that was the dislocation. Well, then there was a boom. The boom in that market was because people could make a lot of money very, very quickly. And they started pushing opportunities to make that money in every possible form they could. Once they used up all of the then existing secondary market, they got into euphoria, where they started to focus so much on delivering these products to the market that they started looking a little less in size. Think of it this way. Housing is divided into what? Primary and a secondary market, right? The primary market is the buying and selling of houses. The secondary market is the exchange of mortgage-backed securities, asset-backed securities that fund the primary market. Well, generally, the secondary market services the primary market. At least that's the concept, right? You originate loans in the primary market. They buy those loans from you as bundles in the secondary market. One is serving the need of the other. That's the concept. But here, with this particular euphoria, you had a little bit of an opposite effect. They're making so much money in the secondary market, they're like, hey, primary market, send us more. Matter of fact, we can assess risk so well, we don't even care what's in it. You want a Nina loan? Cool. Who knows what a Nina loan is? Anyone know? Nina? N-I-N-A? No income, no asset verification. Also known as liar loans. It's okay, put it in there. We'll bundle it and we'll assess the risk and we'll tranche it and we'll make it all make sense. We're going to make money, we don't care. That was the excess in the euphoria in the secondary market. Now this time, Minsky was a little bit off, or Minsky didn't quite exactly match up. Because Minsky says the next step is profit taking. As if people are satisfied with the money that they've made, now they're going to take their money off the table. Well, this was a little different. That's not what caused a change or shift in the secondary market this time. What caused the change or shift in the secondary market was a spike in the default rate. Now, that spike in the default rate was caused by two factors. People won't like to focus on the one, but it was two factors. One was fat loans to people that couldn't afford it. But you know what? Do you know how long there have been bad loans? Since the beginning of lending. Go back to ancient Mesopotamia and you'll see some bad loans. There have always been bad loans. But the exposure to the bad loans was excessive or exacerbated by the secondary market, by the leverage effect of derived securities or derivatives as opposed to principal securities. The second factor, which I think really was probably more significant than the bad loans, was the decision to pop the bubble. Anybody looking at that last chart could see that there was a bubble in housing. The Fed could see that there was a bubble in housing. Everyone could see that there was a bubble in housing. After 9/11, they kept rates low, and with some good reason. I mean, they were really worried that Osama bin Laden was going to succeed by killing the economy because of the effects on the psyche of America after the towers fell. So yeah, they dropped rates and they held them down there for a long time. Well, did they hold them down there too long? You'll get a lot of people that will say yes. But I would suggest that their failure to recognize the significance of the financial activity and the activity that was going on in the secondary market and the ultimate dependency of the greater economy on what was going on in housing, their failure to recognize that was probably their worst mistake. Because they started ratcheting up the rates consistently until they reached the recent high. And they held that high all the way until, guess what? They recognized this crash that I'm talking about in this presentation. So in any case, once that change in direction in that line, or that trend line, took place, instead of profit taking, they saw real losses. And of course, once there are real losses, panic. And once there's panic, the panic doesn't stop until there's actually revulsion. And we know there was revulsion because we all know this term, toxic assets. Nothing's more revolting than something that's toxic. That's essentially what happened.